What happens tax-wise when closing a Canadian branch? Closing a Canadian branch of a US corporation is different from closing a Canadian subsidiary. There is no separate legal entity to dissolve, but there is still a real tax presence that has to be dismantled carefully. The branch may have accumulated assets, losses, tax accounts, and a history of permanent establishment in Canada. When you decide to shut it down, you are really deciding to stop having a permanent establishment and to unwind whatever tax attributes have built up around it. The key is to look at the branch as a bundle of assets, liabilities, and tax accounts tied to Canadian operations, even though everything technically belongs to the same legal corporation that also runs your US business. Ending the permanent establishment. From a tax perspective, a branch exists because the US corporation has a permanent establishment in Canada. That can be a fixed place of business, such as an office, warehouse, or workshop, or it can be people in Canada who habitually conclude contracts or play a central role in the business. Closing a branch usually means shutting down that fixed place and those activities so that, going forward, you no longer meet the permanent establishment test. In practical terms, that may involve giving up leases, terminating employees, or shifting them to a different entity, stopping on-the-ground sales activity, and fulfilling remaining contracts without maintaining an ongoing Canadian base. Once those conditions are met, you can position yourself as no longer having a permanent establishment for future periods. Final corporate income tax filings for the branch. Even though the branch is not a separate corporation, it is treated as if it were a Canadian business unit for corporate tax purposes. You will file a final Canadian corporate income tax return that reflects the branch's income up to the closing date, plus any gains or losses triggered by disposing of or moving branch assets. That can include recapture of capital cost allowance if assets are sold for more than their tax basis, recognition of previously unused losses, and adjustments for intercompany balances that are being settled. After the permanent establishment ends, you generally do not have to file Canadian corporate returns for later years unless you start a new branch or create a subsidiary, but the years up to closure still need to be cleaned up. Branch profits and possible branch profits tax. Under the Canada-US tax treaty, branch profits of a US corporation may be subject to a branch profits tax, broadly intended to mirror the withholding tax that would have applied if those profits had been earned in a Canadian subsidiary and then paid out as dividends. When you close a branch, you may need to calculate accumulated branch profits and determine whether additional branch profits tax is triggered as you effectively repatriate whatever is left. The details can get technical, but the basic idea is that you cannot simply shift all remaining branch value to the US side without considering whether a final layer of Canadian tax arises on the way out. GST, HST, and other indirect taxes. If the branch has been registered for GST or HST, you have to file final returns, remit outstanding amounts, and ask the tax authority to close the accounts. When you dispose of branch assets, you need to think about whether those sales are taxable supplies and whether GST, HST needs to be collected, self-assessed, or can be relieved under specific rules. For example, when you sell the assets as part of a sale of a going concern. If you simply transfer assets from the Canadian branch to the US head office without consideration, the tax treatment can be more complicated than it looks because those movements can still be seen as taxable transfers for sales tax purposes in some circumstances. Payroll employees and final reporting. Where the branch has employees in Canada, closing it usually means terminating those roles or transitioning them into another employing entity. That triggers payroll obligations such as final pay, statutory notice or severance, and last remittances of withheld tax and contributions. You also have to file year-end slips for employees covering the period up to termination and ensure that provincial employer accounts, like workers' compensation registrations, are closed properly once there are no longer any employees on the ground. From a tax perspective, this is about closing the employer profile of the branch in Canada, so there are no lingering payroll accounts that continue to generate notices and assumptions about activity that no longer exists. Handling branch assets and intercompany positions. Many branches hold assets such as equipment, inventory, and receivables. As part of closing, you either sell those assets in Canada, write them off, or transfer them to another operation. Each route has tax implications. Selling in Canada usually produces straightforward gains or losses and obvious GST/HST consequences. Transfers to the US head office or another affiliate need to be priced and documented carefully to avoid unwanted tax surprises. You may also have intercompany balances between the branch and other parts of the corporation or group, especially if expenses or management charges have been allocated on internal accounts. Those need to be reconciled and settled before you can be confident you have a clean end state. Why planning beats drift? Letting a branch go quiet without formally closing it for tax purposes is asking for problems. Tax authorities may continue to expect returns and remittances based on historical patterns and can issue assessments or estimates when nothing arrives. Years later, you can find yourself spending time and money explaining that your Canadian presence actually ended long ago but was never cleaned up on paper. It is far better to treat branch closure as a defined project, mark the closing date, file final returns, deal with branch profits tax if applicable, close GST, HST, and payroll accounts, and document the fact that you no longer have a permanent establishment. Final thoughts. Tax-wise, closing a Canadian branch means ending your permanent establishment, filing final corporate income tax returns for Canadian branch income, handling any branch profits tax, cleaning up GST or HST and payroll accounts, and dealing with assets, losses, and intercompany balances in a deliberate way. Once that is done, your Canadian tax footprint for that branch shrinks from active and ongoing to historic and documented. If you want a practical roadmap for planning a branch exit, including tax and non-tax steps, you can explore more detailed guides at www.theaccountingandtax.com. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.